Surprised at all about this reaction with the U.S. markets? We're seeing futures pull back a bit. We heard a lot about the taco trade, quote unquote. Trump always chickens out. Do you believe that investors now believe that these tariffs will take place on August the 1st?
No, I think that I think markets would be quite a bit lower if investors expected a reversion to, near Liberation Day tariffs for a lot of countries in a couple of weeks. I think that pushing the deadline has clearly led traders to believe that there's plenty of room to negotiate. But these are big levels, and they continue to be pretty aggressive across the spectrum of countries. And with that 10% baseline tariff seeming like the floor, I think if markets believe that these are going to be in place for the remainder of President Trump's term, that markets would be quite a bit lower today. So I think they expect off ramps, whether it's negotiations or whether it's in the courts, quite frankly.
With the threat of these tariffs, though, we've seen a lot of investors go over to Europe to look for opportunities. The threat alone, does that change the attractiveness of the European markets, or at least certain European sectors? Like we saw luxury sell off last week just on the tariff threat when we thought the tariffs would happen, and now we actually see them, supposedly going to start on August the 1st.
No, I think a ramp up in tariff and trade tensions actually makes the European trade a little bit more attractive. One, these tariffs have clearly been a catalyst for a weaker dollar. That's good for international stocks if you're a U.S. investor. But the other thing is, I think that the tariffs and the idea of the U.S. kind of pulling back from a global trading scale a little bit has led Europe and other countries to realize that they need to provide some of their own growth, some of their own defense spending. That's really been the catalyst, is the fiscal impulse, whether it's China, Europe, Japan. So I think that the U.S. kind of leaning in on tariffs is actually something that maybe not in the near term, but over the long term is something that can catalyze that European trade and bring international diversification back to folks' portfolios.
All right. With that, I want to get to your word of the day. What's your word of the day and why? It's a pretty interesting one.
It's baguettes. And I think the reason that we're going with that, momentum begets momentum, right? New all-time highs begets new all-time highs in markets. There's this idea that of how powerful momentum is in markets. And I think people see the trade anxieties, they see the headlines, and they want to take chips off the table because we're back at new all-time highs, valuations are stretched, on and on. But the reality is everything we've seen over the last couple of months begets more of that over the next 12 plus months. This momentum we've seen, this spread thrust off the lows, is a bullish indicator, and we want folks to lean in, not pull chips off the table here.
All right, I want to get to your pick. It's financials. We're going to show the KBE, which are the big banks, and also the KRE, the regional banks. Which area of the financials do you see as more attractive?
Yeah, I like the big banks. I think that there's some, regulatory, tailwinds there, deregulation coming down the pipe. We saw a couple of those headlines last week. Obviously, the mergers and acquisitions, IPO, SPAC story is a lot bigger for the big banks. So I like the big banks. I think that there might be a bit of a sentiment hurdle to get over during this earnings season that's upcoming. Obviously, we're going to be reflecting a lot of what went on during a more tumultuous period for the market. But over the next 12 months, I mean, they're fairly domestically oriented. They've got a lot of tailwinds in terms of capital markets activity and deregulation. And we like the more cyclical sub-industries within the financial sector. So looking at banks over something like insurance, which has been a laggard lately.
Very interesting. So you like banks over insurance, despite, I guess, the real need for insurance that we've seen, not whether it's severe weather or also disruption in the Middle East. What makes insurance less attractive? Very quickly, if you don't mind.
Yeah, absolutely. I mean, it's just a bit more defensive, quite frankly. Obviously, the need is there. That doesn't necessarily result in, higher profits and a better growth story. So I like the banks. I want to lean into cyclical sectors here, especially if we get a pullback on some of these tariff headlines. And the banks to us are kind of it's the semis over software of financials. And we want to lean into, things like semis, things like banks.
Does the cyclical thesis, does it also kind of translate over to industrials, which have been leading all year, and small caps?
Yeah, absolutely. Small caps I'm a little more hesitant on. The rate story is still a big headwind. Small caps have a lot of idiosyncratic challenges. So I want to lean cyclical, but stay high quality and stay in the large cap space. I think that's the way to play the second half of the year.